Okay, you've seen them your whole life, right? Those giant billboards lining the highways, the city streets, they're just there. But what if I told you that behind all that steel and vinyl, there's a really interesting financial story, one you probably haven't thought about? Let's get into it.
No, really. Have you ever actually thought, could one of those things pay me? Sounds kind of crazy, I know. But for a surprising number of people, that's exactly what's going on.
So how is this even possible? Well, it all comes down to one company, Lamar Advertising. Their whole game is basically turning those roadside views, the ads you see, into cold, hard cash in the form of dividends for their shareholders. To really get how this works, you've got to shift your thinking a bit. Don't think of Lamar as just an ad company. Think of them more like a giant landlord, a roadside landlord. And their real estate? Well, it's pretty much everywhere you look. I mean, just look at that number for a second. We're talking about roughly 362,000 displays. That is a lot. And see, that's the key. This isn't just about selling ads. It's about owning and controlling a massive physical network of prime real estate that brands are desperate to get on. That network is their crown jewel.
Okay, so they own a ton of billboards, but how does that turn into a check for an investor? This is where the whole thing gets, well, kind of brilliant. It's all because of this special business structure called a REIT.
All right, so what on earth is a REIT? It stands for Real Estate Investment Trust, and it's pretty much what it sounds like, a company that owns and operates real estate that makes money. But, and this is the absolute key, there's a rule, a legal requirement. They have to distribute at least 90% of their taxable income to their shareholders. That's the secret sauce right there.
So let's follow the money. It's actually super straightforward. Step 1. A big company, say Coca-Cola, pays Lamar to put an ad up. Step 2, Lamar collects that cash, just like a landlord cashing a rent check. And Step 3, because they're a REIT, they take almost all of that taxable income and bam, it goes straight out the door to shareholders as a dividend. Simple as that.
Okay, so that's the model on paper. It sounds great, right? But how's it actually performing? Let's dig into the latest numbers and see what's really going on.
So, looking at their latest quarterly results, it's a little bit of a mixed bag. On the one hand, revenue looks good. Almost $600 million, which was a little better than Wall Street was hoping for. But on the other hand, their earnings per share, the EPS, which basically tells you how profitable they were, it missed the mark just a tiny bit. So they're selling a lot, but maybe not keeping as much of it as profit as people wanted. And just to give you some perspective on the company's size, we're talking about a market cap of around $13.5 billion. So yeah, this isn't some small-time operation. It's a really substantial, established player in the game. And here it is, the main event for a lot of people looking at this company. That dividend yield is sitting right around 5%. Going back to our landlord idea, that's your cut. That's the rent you collect every year just for owning a piece of the property. And honestly, in today's market, 5% is a number that's going to turn some heads.
But, and you knew there was a but, right? A juicy dividend like that doesn't come without some strings attached. It creates this constant pressure because that big payout means the company has to keep delivering again and again.
And this really is the core dilemma here. The appeal? It's crystal clear. The REIT structure forces them to pay you, which can create this awesome, steady stream of income. The concern, though, is the flip side of that exact same coin. Because they're paying out so much, there's not a lot of cushion left over. So when profits get a little shaky, remember that small EPS miss we talked about? You have to start asking, how sustainable is this thing really? So let's pull on that thread a little more and talk about the risks. Look, every investment has them. But for Lamar, the big ones are baked right into the way they do business. First off, the ad market is notoriously cyclical. What does that mean? Well, when the economy gets tough, companies slash their marketing budgets. And that hits Lamar right in the wallet. Then there's the dividend sustainability and the earnings volatility we've been talking about. And lastly, let's not forget competition. Lamar is a beast, for sure. But they're in a constant battle for ad dollars, not just with other billboard companies, but with the entire universe of digital advertising online.
All right, we've talked about how it works, what the numbers look like, and what could go wrong. So let's put it all on the table and come up with a final scorecard. Let's weigh the good against the bad.
So when you boil it all down, what do you get? In the pro column, you have a company with a monster footprint in the market and a dividend that's hard to ignore, thanks to that REIT structure. But in the con column, you've got those shaky recent earnings, real questions about whether that dividend can last forever, and the simple fact that their business will rise and fall with the economy. Which brings us to the big, final question, doesn't it? In a world where we're all glued to our phones, is betting on giant pieces of steel and vinyl by the side of the road a timeless investment? Or is it kind of like buying a relic from a bygone era? That right there is the multi-billion-dollar question you have to ask yourself.